Okay, let's get into this. Welcome, everyone. Today we're doing a deep dive into the different ways people tackle the markets, trading, investing. There are a few different styles.
Yeah, and we've got some material here that breaks it down quite nicely, gives these sort of simple professional takes on several distinct approaches.
Right. So our mission really is to unpack that, pull out the key differences for you because, this source makes it clear these styles aren't all the same.
Not at all. They vary quite a bit in, well, how much time you need to put in, for one.
And the risk involved, too. Big difference there.
Definitely. Risk, potential returns, time commitment, they all shift depending on the approach.
Which is crucial because the source points out, and it makes sense,
Yeah.
that different styles suit different goals, different lifestyles.
Exactly. So hopefully this dive helps illuminate, what that could mean for you, how these things connect.
Okay, so let's start at the really fast end of the spectrum. The source kicks off with scalping.
Scalping, yeah, think speed.
Super fast. The material defines it as trades lasting seconds, maybe minutes. It's very quick.
Right. You're not trying to catch a big wave. The goal is to make loads of tiny little profits.
It's like grabbing just a few cents per share, maybe?
Precisely. But doing it over and over again throughout the day. It's about volume of trades, not size of profit per trade.
Sounds intense. The source says it requires, well, constant watching.
Oh, absolutely. Constant focus. And you need to make decisions, like instantly.
Split-second stuff. And I imagine the psychology is huge, too. Discipline.
Immense discipline. You have to stick to your plan, no hesitation, even when things are moving incredibly fast. Emotional control is key.
Okay, so if we dial back the intensity just a tiny bit, but stay within the same trading day, we get intraday trading.
Correct. Intraday, or some people call it day trading. You're buying and selling, but the key is you're flat by the end of the day.
Meaning all positions closed.
Exactly. All closed before the market shuts.
Why is that so important?
It's mainly to avoid overnight risk. News can break when the market's closed, causing big price jumps or drops when it reopens. Intraday traders sidestep that.
Got it. So the goal is profiting from price moves just during the day's session.
Mm-hmm. You still need to be actively watching the market, no doubt.
But maybe trades last a bit longer than scalping, minutes to hours, perhaps?
Yeah, generally a bit longer. It's still very active, requires daily attention, but maybe not quite the frenetic pace of pure scalping second by second.
Right. Okay, so stepping back again, what's next in the time frame?
Then we get into swing trading.
Swing trading, now we're talking about holding for a few days, up to a few weeks.
That's the typical time frame, yes. You're trying to capture a swing in price, like a medium-term move within a larger trend.
So not the tiny fluctuations like scalping, not just the day's moves like intraday, but maybe a move that unfolds over several days.
Exactly. Riding a bigger wave for a bit longer.
And how do swing traders figure out when to get in and out? The source mentions technical analysis.
Yeah, technical analysis is usually a big part of it. Looking at charts, patterns, indicators, trying to time those swings.
Less about the second-to-second news flow, maybe.
Generally, yes. It's less intense on a minute-by-minute basis compared to scalping or intraday. You might check things a few times a day or even just once.
Okay, makes sense. So longer hold than intraday leads us to.
Positional trading. Taking another step back.
And the time frame here, weeks to months.
Weeks to months, sometimes even longer. You're aiming to ride major trends, not just short swings.
So the potential profit per trade is probably aiming higher here, capturing a bigger move.
That's generally the idea, yes. Because you're holding through more significant price changes, hopefully in your favor.
And the analysis changes a bit too. The source says it's a mix.
Right. Positional traders often blend technical analysis with fundamental factors.
Fundamentals like company health, economic news.
Yeah, things like that. Big picture stuff. Major economic shifts, industry trends, company earnings, reports things that might drive a price over weeks or months, not just hours or days.
So fewer trades than swing trading, probably, but each one is a bigger commitment, looking for those larger, longer-term shifts.
You got it. Less frequent activity, but aiming for more substantial gains per position.
Okay. Now, the source material seems to make a bit of a shift here, moving from trading towards investing.
That's a good way to put it. The time frames get longer, and the mindset starts to shift too. First up in this category is short-term investment.
Right. And the holding period here is months to maybe a couple of years.
Yeah, that's the zone. Clearly longer than even positional trading.
And the goal, still capturing trends.
Sort of, but maybe broader market trends or specific company events expected over that medium term. It's less about the daily chart wiggles and more about Say, a company launching a new product line or benefiting from an industry cycle over the next year or two.
So, achieving moderate gains, balancing risk and reward over that, let's say, 1 to 2 year view.
Exactly. You're considering things that play out over several quarters, maybe looking more at company milestones or market themes than just pure price action.
Okay. And that leaves us with the longest time frame mentioned.
The classic, long-term investing.
This is the buy and hold strategy most people think of, right?
Yeah.
Years, decades.
Precisely. Buying assets and holding them for a very long time. Patience is absolutely central here.
What's the main goal? Just steady growth.
It's really about long-term growth and wealth accumulation. And a huge driver for that is compounding.
Compounding, where your returns start earning their own returns.
Exactly that, the snowball effect. It really works its magic over long stretches of time, years and decades.
And unlike the trading styles, the source emphasizes that long-term investors focus heavily on fundamentals.
Absolutely. They're looking deep into the underlying business. Is it profitable? Is it well managed? Does it have a competitive advantage? What are its long-term prospects?
So less concerned with the daily or weekly price swings.
Much less concerned. In fact, the source notes they often deliberately ignore short-term market noise, all the ups and downs.
Because their focus is way out on the horizon.
Way out. They believe in the fundamental value and growth potential over years, even decades, regardless of short-term volatility.
Okay, wow. So if we just pull back and look at the whole picture from the source, we've gone from seconds-long trades with scalping through intraday swing positional trading
Right.
into short-term investing and finally landing on long-term investing, holding for potentially decades. It's quite a spectrum.
It really is. And the consistent theme from this material is just how different each point on that spectrum is.
Different time commitments, different risks, different potential rewards.
Totally. You can't just swap them out easily. They require different skills, different temperaments, different amounts of capital sometimes.
Which loops back perfectly to that main idea. These styles fit different people, different goals, different lives.
Yeah, it's not about which one is best overall, but which one, or maybe even which combination, might be best for you.
So we've taken this deep dive, using the source's professional perspective, looking at these 6 distinct approaches: scalping, intraday, swing, positional, short-term, long-term.
We've tried to pull out the core features, the time involved, the goals, the typical analysis, what they demand.
And the source really hammers home that because of those differences in time, risk, and return, they align differently with individual circumstances.
Which kind of leaves a big question hanging there for you, the listener. Thinking about these clear distinctions the source lays out, how might mapping these differences help you consider which approach, or maybe blend of approaches, really fits your own resources, your financial aims, and just as importantly, your own personality?